So we talked about the the interest rates, inflation within the context of how interest rate inflation and exchange rates are related. And since the beginning of the semester, we've been talking about this crawfish trade, where the money internationally is almost on a flat earth. And as we have risk and return um, situations change from one country to another, the money actually moves from one country to the other. So we kept saying that only two things matter for this international flow of funds, and one is the return, and the other one is the risk. So, which is completely correct. It just now that we're talking about inflation into this equation, um, I don't want you to feel that inflation is the third. It actually is not. When you consider the real interest rate, the real yield, that's where the inflation comes into play. So again, only two things matter for us. The one is interest rate, but it is the real interest rate that is after the inflation. And inflation is always expected. So unfortunately, we don't know it before we make our investment. We have our predictions. However, it's always expected. And we have a nominal interest rate, and we unfortunately don't know what the real yield will be, up until the end of the maturity for our investment. And the risk situation, again, we have an expectation as to what the risk situation is relative to other investment vehicles and other countries. So we make our, rebalancing of our international flow of investments based on our expectation of real interest rate and the expectation of risk. And based on that, the money flows. And the example of a crawfish tray is, you know, is to show that when the money moves, it actually moves from one country to another. And, you're not making up new money when, the investment situation improves in one country. It actually moves from one to another. That's why the crawfish tray is a good example in the sense that when it tilts towards the country, the money will flow to the country from another one. So the issue now is, how does that affect the exchange rate, right? And that's the topic of today's discussion. So I have the dollar euro exchange rate on the screen. And, one thing that I want to emphasize is, we've been talking about how the exchange rate is the value of one currency versus the value of another currency. So, if you're talking about the dollar euro exchange rate, you're literally talking about the value of the dollar and the value of the euro. So first of all, we will need a measure that is a little bit more, you know, that can a little bit more isolate an individual currency. So I want to talk about the value of the dollar, and I really don't want to talk about the euro. Right? So, and within the context of our example of a crawfish tray, when the money moves because there's a better yield in one country or a better risk situation in one country, um, it actually flows towards a country. And when the money moves into a country, when foreign investment moves into the country, it demands the currency, the local currency, which increases the value of the local currency. Meaning, if the risk situation in the US gets better and the foreigners want to invest in the US, whatever currency they come with, they have to convert it into the US dollars and demand US dollars, and therefore invest in US dollar denominated investment securities. So, and this demand increases the value of the US dollar. So the one thing that we usually deviate from the econ theory in finance is that with econ, everything is all about the supply and demand, which is completely correct. However, when it comes to the value of a currency, the supply and demand usually does not play as or does not fit in as nicely as it should, simply because the supply of currency does not change in the short run. The supply of the currency, creation of money in one currency, takes multiple months, multiple quarters, and sometimes multiple years. So it's not like the example of, say, tomatoes, where, if the demand for tomatoes increase, but at the same time the supply of tomatoes increase, the equilibrium will simply stay the same, simply because, along with the demand, supply has changed. But when it comes to money, the creation of money, the increase of supply of money, does not happen in a short period of time. It's actually a monetary policy. So when we are talking about the crawfish trade, when the money moves from one country to the other, we say the foreign investment is coming towards a country. So let's say that in the US, the risk has gone down, or the yields are going up, and then the inflation is going down. And when the inflation goes down, yield goes up, the real yield goes up. And therefore, foreigners want to invest in the US, which is a good thing. So what will happen is this foreign currency will be coming to the US, demanding a conversion into the US dollar, and therefore creating a higher demand and for increasing the value of the US dollar. But when these same foreigners want to leave US, and when they want to, get rid of the US dollars in favor of their other currencies, you know, sometimes people refer to this as this creates a higher supply. It really does not. What it does is it becomes akin to a dumping of a currency. So all you really are doing is you are trying to sell the US dollars by creating a negative demand, and therefore that negative demand lowers the value of the currency. Simply, you don't want it, and therefore, if all the foreigners who want to leave don't want the US dollars, they simply dump it, and once they dump it, the value of the currency goes down. So, in the context of the crawfish trade, when the money comes to the country, flows towards the country, then there will be higher demand for the local currency, which increases the value of the currency. But when the money is leaving the country, then the foreigners are dumping the local currency, which lowers the value of the local currency. So in this case, when you're looking at dollar euro, it's not really that indicative, because you are looking at two currencies. So first of all, we need to fix that. So there is a what's called a basket. We talked about it a little bit in class, and it's a U.S. dollar index. You see how this actually now immediately changed. So it is an index in the sense that it is the US dollar value against a, um, a several different foreign currencies, and therefore, or a basket of foreign currencies, and therefore, it is the true value of the US dollar. It's an index, and therefore, the index of 100. So therefore, when the dollar loses value below 100, that means that it's simply weak currency. When the currency goes above 100, then you are actually on a premium. So with respect to the current level, the exchange rate, well, the index, the basket is right now at a 106 and change. And notice how it has been increasing recently. So if you look at this since COVID, for instance, notice that first the US dollar has declined about 10% from 100 down to 90. And then we had this, significant dovish monetary policy by Fed by lowering the interest rates so much that actually led to the dollar to gain value, which is actually counterintuitive if you think about it, because we have kept saying that as the interest rates increase, the yield will increase, and therefore the money is supposed to be coming to the US. And here we know that the Fed has been lowering the interest rates right after COVID until they realize there's they call it significant inflation. This actually is supposed to be that as the interest rates in the US went down to zero, the money is supposed to be flowing out, and therefore the US dollar value is supposed to be coming down, but it's not. It's actually increasing. So this is where the second variable into our equation comes along. It's the risk. I think that the reason that the dollar has gained in value so much, even though Fed has been decreasing interest rates, is because the international investors saw US as the least risky among all the other investment or investable countries. Compared to other developed countries, US actually fared better. And then I think that it also has to do with the psychology of COVID. When Europe is more about larger cities and a little bit more compact, and in the US we're a little bit more um, suburban and perhaps rural, and therefore our recovery perhaps is expected to be faster, and which turned out to be true, which in the long run led to the expectation that US is less risky and it will fare better, after the COVID recovery. But then afterwards, this is also counterintuitive in the sense that Fed started to increase the interest rates. They changed the monetary policy significantly from dovish to hawkish, and they made zero interest rates up until I think 5.25 now. And because the interest rates are increasing, you would have expected the US dollar value to go up. However, again, this is where the inflation comes in. Now, please, see that the inflation eats away from the interest, right? It's all about expectations of international investors. You are making an investment based on your expectation of net earnings. Your nominal interest rate, the interest rate that you were actually pronounced at the time of your decision is only true if your inflation was fixed, which it's not. And therefore, at this point, the dollar is losing value, not because the interest rates are, increased, but it is actually because the inflation now is so much higher. So to this, what I want to do is I want to actually add the say S&P 500 to this chart, just to show you how it actually works along with the markets. And notice now that the orange is the S&P 500, the SPY ETF, and then the blue is the US dollar index. And notice there's a correlation between the two. So, in a way that it shows the international, and perhaps global investment appetite for US dollar denominated assets, namely the S&P 500. So notice how, first of all, during COVID, that even though the market has crashed, US dollar was gaining in value a little bit. And then afterwards, along with the US dollar value, we have a significant recovery. So you have one right here, and notice that we actually have another one right here, and that's your dollar value, right? So I think that it actually shows how, with respect to the corporate trade and how the international demand for US dollar denominated securities in this example, S&P 500 stocks, we actually have a very, correlated relationship between these asset prices, security prices, and the US dollar's value. And going forward after that dovish to from dovish to hawkish monetary policy change, we also have a very similar correlation between US dollars value and the asset values, security prices, stock prices. And but notice there's actually a lag between the two. So first the stock prices go up, and then the US dollar value goes up. So that lag might actually explain how it actually takes a little bit longer for markets to perhaps observe the actual change, and then have these expectations of risk and return to settle in. And but I'm not sure why it actually took 2 years uh, for that lag. Well, again, I think it will be too simplistic to assume that when the interest rates go up, the exchange rate or the value of the currency would go up. All I'm trying to say is that it's actually a two variable system with an eventual result. That's the exchange rate. The first of all, the variable number one is your interest rates, net real earnings. So that is your interest rate minus the inflation, right? And then two is the risk. So the our chapter for this week is interest rates, inflation, and its effect on exchange rates. But in effect, we are actually talking about, when you say interest rate inflation, you are actually talking about one single variable where the inflation is a component of interest rates. And however, obviously, one kind of leads to the other, and it may not be as easy to link the interest rate to inflation, all that, definitively. But anyhow, so one thing that I want to show is the value of US dollar versus the actual yield. Now, again, this is, the nominal yields, treasury yield, and I'm going to add TNX. This is the 10-year US Treasury yields. And notice how the orange line is the 10-year US Treasuries. And notice how, even though the US Treasury yield have been, okay, so let's actually add that again. So this is the yield, right? It's not the price, it is actually the yield. So notice when the yields are going down, the US dollar is maintaining its value. And there's only a slight change. And when the yields are going up, there is a slight increase. So right there, you can actually perhaps see right there. So when the yields are going up, you actually have a little bit of an increase in the US dollar value. However, leading into the COVID and then at that COVID era, the relationship seems to be counterintuitive to all the discussion that we have in our textbook and all the discussion that we've been talking about. And, this is again why I want to explain this to you rather than giving you formulas and functions and say, if interest rates go up, the value of a currency will go up because it will attract foreign investments. It simply is not correct. There are so many different variables that feed into the ultimate two variables that we always talk about, and that's the net yield, and the risk. So I think that even though when the U.S. Treasuries, especially the 10-year, were declining, and US dollar was maintaining its value. And I think, again, it had to do with the risk of US compared to other countries. So there comes the catch. When we talk about interest rates, risk, inflation, and how it affects the exchange rate, the second most important issue that we need to understand is that it's always a relative discussion, meaning we do not actually talk about the US dollar value in a vacuum. The crawfish tray has these, Sharpies marked all around, which means that for any investor, you have the choice of investing in any country, in any asset, and therefore you could literally, rebalance your portfolio with a moment's notice in any country. Therefore, when you are investing in the US, you're investing in the US, but that's also the decision of not investing in other countries. Therefore, it's always a relative decision that you are making. So when we talk about how the US treasuries are declining, and therefore we should expect US dollar value to decline as well, that would be looking with a very narrow perspective in the sense that if the US yields are declining, first of all, we also have to look at the inflation, which we will in a minute. But if it is actually declining, however, it is still higher than the other countries, that would also mean that the money would flow towards the US that would maintain the value of the dollar. So, I think that it will be too simplistic to simply say that if interest rates go down, the currency value is supposed to go down because international investment will not come. Well, interest rates may be coming down, but if the other currency interest rates are coming down faster, then our own currency is still better than the others, and therefore we might maintain the value of our currency. So I guess the last portion of this is to include the inflation into this, although I will do this a little bit reluctantly. So this is year on year inflation, and notice the reason that I've been reluctant is because there's always that expectation that the interest rates and the inflation goes hand in hand, and like I said, for Fed, the inflation is a target. I mean, obviously, they want to keep it at a certain level, but the feedback that you get from economy, unfortunately, is not as frequent as you wish. You get monthly updates, but better yet, you actually have your GDP on a quarterly basis. You have money creation data from banks, and all in all, it's a delayed or a lagged system. So, although if you look at the orange and this light turquoise color, you will see that there is a relative you know correlation, except for this part. So I think that the correlation have been broken starting this up until recently. So within that area, within this area, that correlation is broken. I mean, and Fed admits that. I mean, it was unprecedented event, once in a century event, and I don't think anybody expected the inflation to be sticky, and the expectation was that inflation to be transitory. So, and the argument always is that it's an expected inflation, and if you invested in 2020 with a horizon of say 10 years, well, you kind of caught up. So, in fact, what happened here is just an opportunity cost that you kind of missed some better investment opportunities. However, with respect to your position for that investment, nothing changed because you see how they became correlated eventually. So when you look at the interest rate and inflation, um, and this is our this week's topic, right? The relationship between the orange, the turquoise, and the blue lines, the interest rate, inflation, and the exchange rate. The exchange rate is an eventuality of how these two are relatively higher or lower compared to other countries. And the only variable we're missing here is the risk. And the risk is a perception. So obviously we have, risk measures like VIX, for instance, that we look at, the implied volatility and all that, but they're all short term. Overall, for international investments, you are looking at investor perception. Which countries do you perceive to be less risky for investment on a long term for your money? So, for instance, recently Germany is at a significantly higher risk simply because they're dependent on Russian natural gas. And as long as Russia and Ukraine are in a war, their economy, German economy, is at risk. Very similarly for France, for Italy, for Austria. I mean, many of the European countries are now trying to figure out how they're going to fuel their economy if if Russia were to cut natural gas even further. Um, the oil prices are also at risk now that, the Iran and there's a risk that Iran could actually be involved in the Middle Eastern war. The Israel and Palestine military conflict might actually increase oil prices, and all of this is risk. And then when you look at it, U.S., well, we are about an ocean away from all of this military risk, which for a lot of international investors, it usually is a preferred country, simply because, like I said, we are about ocean away from all that risk. We're not self-sufficient with respect to energy, but I think that compared to other countries, we're still less risky. So I wish that I could actually turn that perspective into a chart here, and that would explain why probably the dollar value, the index value, is or looks pretty flat. And even though the inflation has been significantly higher, even though the yields have been very volatile, that they probably have never been that I've seen, but our dollar value is pretty stable, and I think that it also has to do significantly with the risk being significantly stable for the U.S. compared to other countries. So I think that if it was up to me, I would want it to change the name, the topic for this week, and I would make it interest rate parentheses inflation, and then comma risk, and and semicolon exchange rates, because the exchange rate is an eventuality based on how your crawfish trades tilted one way or the other, how much money comes in the international flow of funds. You will have a demand for your currency, or you will have foreigners dumping your currency, and that will determine the value of your currency. And so, we talked about how the countries might choose different currency regimes to maintain the value of their currency. However, you're still looking at a very significant market forces trying to, pressure or trying to find an equilibrium of value for a currency. But one thing that I want to emphasize is that we usually should not be talking about the exchange rates, but we should actually be talking about um, a currency index or a basket. Um, so that's about it for the exchange rates and how it's related to the interest rate and inflation and risk. So thank you for working with me, and please let me know if you have any questions. And I hope to see you soon. Thank you. Bye now.